Have you ever wondered how owning a small piece of a company can make you wealthy over time? What if the secret to building real financial freedom is not earning more, but understanding how stocks actually work? Today, we are breaking down stocks step by step so you can see how ownership creates wealth, even if you start with just a little money. Don't forget to like and subscribe to get these essential strategies that can grow your money smarter and faster. 1. What are stocks? Stocks represent ownership in a company and give you a claim on its profits and assets. When you buy a stock, you essentially become a part owner of the business and can benefit from its growth and success. Companies issue stocks to raise capital for expansion, research, or other projects. Investors buy stocks hoping the company grows in value over time, which increases the price of the shares. Dividends may also provide a steady income stream. Understanding this basic principle allows you to see stocks not just as numbers on a screen. 2. How ownership works. Owning a stock means you share in both the profits and risks of a company. Profits may come through rising stock prices or dividend payments, while risks include market fluctuations or company performance issues. As a shareholder, you also gain voting rights in some cases, influencing company decisions. This ownership perspective changes how you view investing because it emphasizes patience, research, and long-term thinking. Investors who see stocks as partial ownership instead of just a trading tool make smarter decisions. Ownership creates wealth by giving you a real stake in businesses that grow over time. 3. Capital gains explained. Capital gains occur when you sell a stock for more than you paid for it. This increase in value comes from the company's growth, market confidence, or industry trends. Understanding capital gains is essential for long-term investing because they are the main source of wealth creation for stockholders. Investors focus on buying quality stocks at reasonable prices and holding them while they grow. Patience is critical because quick trading can lead to missed opportunities or losses. 4. Dividends. Dividends are payments companies make to shareholders from profits, providing a steady income in addition to potential stock price growth. They reward investors for holding shares and can be reinvested to increase total returns through compounding. Not all companies pay dividends, but those that do often signal financial stability. Reinvesting dividends allows you to buy more shares automatically, accelerating wealth creation over time. Understanding dividends helps investors balance growth and income strategies while benefiting from both forms of returns. 5. The role of market fluctuations. Stock prices move constantly based on supply, demand, and market sentiment. Short-term fluctuations can be stressful, but long-term investors focus on company fundamentals rather than daily price swings. Understanding that volatility is normal prevents emotional decisions that could harm wealth-building efforts. Markets often reward patience, and disciplined investors can take advantage of temporary declines to acquire more shares at favorable prices. Viewing stocks as ownership rather than just numbers helps you maintain perspective during ups and downs. 6. Research and analysis. Successful stock investors study the companies they own or plan to buy. This includes examining financial statements, growth potential, competitive advantages, and industry trends. Knowledge reduces uncertainty and improves decision-making. Investors who analyze carefully can identify opportunities others overlook and avoid overpriced or weak stocks. Continuous learning and evaluation create confidence and prevent impulsive choices. Research also informs risk management, helping you maintain a balanced portfolio. 7. Long-term perspective. Wealth from stocks rarely happens overnight. Long-term thinking allows investors to ride out market cycles and benefit from compounding growth. Owning stocks for years or decades can multiply your initial investments significantly as companies expand and profits increase. Patience reduces the impact of short-term volatility and helps maintain a disciplined approach. Investors who understand the value of time can create predictable growth rather than chasing quick gains. 8. Diversification. Diversification spreads investments across different companies, sectors, or industries to reduce risk. Owning multiple stocks prevents a single, underperforming company from heavily impacting your portfolio. Diversification allows participation in growth opportunities while protecting against unpredictable losses. It is an essential principle for investors seeking to build wealth consistently. Smart allocation balances potential returns with risk tolerance. 9. Understanding fees and taxes. Investing in stocks involves costs such as brokerage fees, management fees, and taxes on gains or dividends. Ignoring these factors can reduce net returns over time. Understanding how fees and taxes affect your investments allows you to choose cost-effective solutions and maximize profits. Strategies like long-term holding can reduce tax burdens and increase overall gains. Being aware of these details ensures your stock ownership remains efficient and profitable. 10. Review and adjust. Regularly reviewing your stock portfolio ensures it aligns with your goals, risk tolerance, and market conditions. Rebalancing prevents overweight positions and maintains strategic allocation. Monitoring performance, company developments, and industry trends allows adjustments to enhance growth or reduce risk. A disciplined approach to review and adjustment strengthens your investing system and keeps wealth creation on track. Owning stocks gives you real participation in company success and the potential to grow wealth steadily over time. By understanding how capital gains, dividends, diversification, and careful management work together, you can create a system that turns stock ownership into a reliable path to financial freedom. Don't forget to like and subscribe so you never miss these essential strategies that make investing smarter, safer, and more profitable for your future.